Oil started the week clawing back some of last week's deep decline, rising from its lowest close since 2021. Crude has tumbled over the past 3 weeks as the broader market mood has become more bearish. The latest weekly CFTC report showed speculators continue to unwind their crude exposure, slashing bets on an oil rally to the lowest ever. So are prices set to slide further? Joining me now to talk about all that is Reid I'Anson, commodity economist at Kpler. Welcome, Reid. So starting off with Morgan Stanley, today they cut its forecasts for the year for the second time in a matter of weeks. So what are your price expectations?
Yeah, we tend to align with the general bearish sentiment in the market right now. We're moving into a period that's not only seasonally weak for demand, but it just seems, especially the demand prospects in China look relatively weak right now, and that is driving our price forecast expectations. We think by the end of the year, prices are likely going to be trading closer to 70 relative to trading closer to 80 at this point. So I would say if you're thinking about maybe a price band over the next several months, look to see Brent spot likely trading in a band between 70 and 75.
Recent weaknesses as well, prompting OPEC Plus to defer a plan to relax supply curbs by 2 months. We did see S&P Global, they're now expecting OPEC Plus to start output increases next year. So Reid, what's your timeline?
So we see OPEC Plus production rising around 600 KBD next year, likely beginning in Q1. However, we do caution there is a distinct chance that they have to push that back further. Obviously, if they start to bring a lot of production onto the market, that could be very negative for prices. So I would say target Q1 right now to ease those production levels and maybe 500 to 600 KBD in additional production next year.
Plenty of market insights coming up this week as well. OPEC, the EIA and IEA all publishing their monthly outlooks. We did see last month OPEC cutting their forecast for global oil demand growth for the year. Can we expect the same this month?
Very likely going to see another cut in oil demand coming. Obviously, to start the year, OPEC was very bullish around oil demand growth. They continue to ratchet those expectations lower. I think that trend will absolutely continue this month.
So you did mention weakness in China, and commodities have been long entwined with China's economic performance. Are economic woes and their downside effects for oil demand set to last?
Very likely going to continue through the second half. Our Q3 estimate for Chinese refinery runs is showing a decline of roughly 800 KBD year over year. We think that refinery runs will start to rebound into Q4, but very likely that runs will be flat at best through the final quarter of this year. Problem is that Chinese consumption just remains too weak, and the investment channel, which is where they've really been driving growth through the first half, is really getting overstretched and requiring ever higher amounts of debt accumulation. And so I think if China does want to start to get out of this cycle of weakness, they need to find ways to stimulate consumption. Whether the government decides they want to move that route is an open question. We really haven't seen a lot of that yet. So if we don't see the government stepping in and looking to provide a lot of fiscal stimulus to households, I think the demand picture in China will remain quite weak through the rest of this year.
So turning over to the US now, Reid, and the debate between a 25 or 50 base point cut from the Fed at its upcoming September meeting has dominated the market narrative. So could a cut boost the price of oil?
I think it's mostly priced in at this point. The big question is, do we get 25 or 50? Our opinion at Kpler is we will get a 25 bip cut in September. They'll likely look to pause in November, and we'll get another 25 bip cut in December. But keep in mind, a lot of this has been priced in. You'd need to see within U.S. economic data a big surprise to the up or downside to have an impact on oil prices moving forward. Keep in mind, though, the larger question now is what is the pace of rate cuts into next year? Because that's ultimately going to dictate the strength of the U.S. dollar. And obviously, you know as well as I that the strength of USD is a big determinant of oil demand, especially in emerging economies.
So just finally, Reid, we did see today's rebound partly in response to the potential hurricane near the U.S. Gulf Coast. So how disruptive could the storm be on U.S. refining?
It's important to keep in mind that the major U.S. refining bases are centered along the Gulf Coast in Houston, Beaumont, Port Arthur, and in Louisiana. This storm is looking to be on the weaker side, maybe a Category 1 or Category 2 storm. And most of those impacts, though, will likely be felt in Louisiana, possibly into Lake Charles and New Orleans. So certainly could see some impacts to refining. Keep in mind, though, that the big exporting regions in the U.S. for commodities are really going to be towards the west, along the Texas coast, and those regions will not face as many impacts, it's looking like at this point.
Reid I'Anson of Kpler, thank you very much for your thoughts.